Hi, and welcome to our next video podcast for Florida Housing Finance Corporation, presented by Mortgage and Credit Center and onlinehousingtraining.com. Today we're going to talk about new trends in bank responses to foreclosure. I'm John Little, one of your presenters today. I have over 15 years professional experience doing training and consulting work with nonprofits as well as the banks. I'm one of the managing partners of the Empowerment Consortium and also onlinehousingtraining.com. So allow me to introduce one of our other presenters for today, Mrs. Cora Fulmore.
Hello, my name is Cora Fulmore. I'm with the Mortgage and Credit Center. I've got a little over 25 years of experience in the mortgage and credit counseling industry and truly enjoy this particular field. We've got a lot of information to share with you today. I'm going to turn it over to our other co-presenter, Shane Darasol.
Thank you, Cora. As John mentioned, I am the other partner of the Empowerment Consortium, onlinehousingtraining.com. I've worked for three of the top banks in the nation over the past 14, 15 years. National trainer and author, and with that, why don't we go ahead and get started with this?
All right, so what we're going to talk about today is we're going to talk about some of the new trends in banking in response to foreclosure. We know that foreclosure is one of the big problems that we deal with in Florida, and Florida Housing Finance has tasked us to do some training and education and sharing some information with the counselors about what's going on. And they have a strong grasp of the counseling industry, but we know that we can't do anything without the banks.
Absolutely.
And what's starting to happen is the banks are starting to change a few things about the way that they've been addressing this foreclosure issue as well. So, Shane, let me throw it to you first. What are some of the trends that we're seeing recently from the banks in response to the foreclosure situation here in Florida?
Okay. Well, when we're talking about trends and what the banks are doing, three banks come to mind, and I'll try to do them in order. Not necessarily in order, but the three banks that I want to talk about, it's going to be Bank of America, Wells Fargo / Wachovia, and Chase / Washington Mutual. And with Bank of America, they recently announced, and Corey, you can help me with this, announced some of the things that they're doing in terms of trying to help those homeowners there that are impacted by the threat or possibility of foreclosure. But I want to make sure that I position this correctly. That particular program of Bank of America, which is great, is only limited to those countrywide borrowers and those borrowers that have loans that are at least 120% of the current market value. Am I right?
Absolutely.
Also, there are some other factors that come into play. These countrywide homeowners also have to be at least 60 days past due on their mortgages, and the way Bank of America, the information the Bank of America is sharing about this should help about 45,000 affected homeowners. So that's Bank of America. Mm-hmm. The next one I mentioned, I believe, was Wells Fargo / Wachovia, and they're actually becoming aggressive and more proactive. I think they formed somewhat of a relationship with some nonprofits in certain areas. I'm speaking specifically of I don't want to mention the actual large nonprofit, but they have actually become more aggressive in terms of reaching out to affected homeowners and working with them right where they are in terms of being able to meet the homeowner right where they are in terms of their issues and helping them come to hopefully a permanent positive resolution, meaning that helping them actually stay in their homes. And as we go through this, maybe I'll cite some of those examples. The other bank that I wanted to talk about was Chase / Washington Mutual. And as you know or may not know, Chase has established home ownership preservation centers, if I'm saying that correctly, and they are positioned in the hardest hit areas, right where Chase / Washington Mutual has a large footprint in terms of they've originated a lot of loans in a lot of these areas. So they've actually made it very, very easy for the homeowner to come into an office, sit down with a Chase representative that will get the bank people on the phone and be able to work through a resolution. Mm-hmm. So those are the three that I wanted to kind of touch on.
And Corp, I know Bank of America is taking an additional step in addition to being more proactive in some of the mortgage write-downs and some of the processes that they're going through. They're actually out there in some of the communities, right?
Absolutely, absolutely. And Shane, I'm really glad that you chose to identify those three lending institutions, because all of them are the major lenders that are doing a lot or have done a lot of paper in the state of Florida, have originated an awful lot of loans. Bank of America was the very first one you talked about. Bank of America has also gone as far as to do an actual road show where they're actually going into the hardest hit areas. They're working with counseling agencies. They're asking the counseling agencies to be a part of this particular initiative in order to be able to help more families that are being faced with a foreclosure. They're seeing the value of adding counseling to the process. And as you mentioned before, only so many loans are going to be able to be impacted by the principal balance reduction. We're not talking about billions of loans that are going to be able to get some assistance. And I think it's really important as counselors that we tell that message. Not too terribly long ago, Bank of America actually brought in the counseling industry in the Central Florida area and actually provided training for those counselors so that they would be prepared once the program was announced. So that's a really good thing. You were about to say something.
Well, no, I just wanted to mention that, specifically Bank of America, but all three of the banks are not afraid of that term, where the term principal write down. And specifically Bank of America is willing to go as low as reducing the principal balance as much as 30%. And that's huge if I'm an affected homeowner, where in an example like that, if you're going to reduce my mortgage balance by $60,000, $70,000, $80,000, then that's going to change my position in terms of being able to go back out and be able to feed my family and take care of things. So I think it's huge that they are hopefully setting the standard for the other banks to follow, and we'll see how that trend goes as well.
Yeah. Absolutely.
It's probably important to note that is going to be on a case-by-case basis.
Absolutely.
And there are going to be a limited number of people that will be eligible for that based on the specific criteria that they set forth.
Absolutely. And the criteria is, there's always the devil in the details kind of thing. So we need to make sure that we're very clear that it's not just straight across the board, that there are some criteria that the consumer has to meet in order to be able to qualify for this. You also mentioned Wells Fargo, and recently there's been an outthrust of Wells Fargo to work with nonprofit organizations and counseling agencies. And not too terribly long ago, I met with an agency that is actually doing the counseling for them, and I think this is a tremendous step in the right direction with Wells Fargo since they've taken over Wachovia, and I think this is a very, very good step in the right direction to be able to help families. Now, and the last one that you mentioned was Chase, and my hat goes off to Chase because they stepped out early in setting up these homeownership centers for families to actually walk into a center and be able to sit face to face with a counselor on the Chase staff and be able to work with them. And the good thing that Chase has done that I feel is a positive step in the right direction is the fact you mentioned that they are in the hardest hit areas, and you are absolutely right. Not only are they in the hardest hit areas, they've seen that there's a need to add more offices in the state of Florida and also throughout the country to be able to reach and meet the needs of the families that are facing foreclosure. So they've done a lot of things that I think is very positive, and this is a really good trend for housing counseling and also to be able to reach those families that are facing foreclosure.
Absolutely. And one of the frustrations, quite frankly speaking, one of the frustrations that we've seen from the counselors and from consumers has been the bank's responses. So why do we think that the banks have changed the way that they're doing some of the things? Why do we think that we're seeing a shift in some of these trends?
Can I take that one?
Absolutely.
And again, I take a little bit more radical approach than the two of you. But the question was, why do I think banks are responding this way? I think the media is playing a role. I think the Treasury Department is putting pressure on them. I think specifically the President is putting pressure on them. And finally, who would believe this, but it actually can help their business down the road. Maybe not right now, but if I know that Bank XYZ actually reached out to me, I may want to do business with them down the road once I recover.
Absolutely.
So I think that's a combination. And Corey, did you want to?
Well, Shane, you're absolutely right. But I think another caveat to this whole thing is the status quo doesn't work.
Right.
The status quo, the way that they've done it in the past, no longer works. So there has to be a change. And the lenders are recognizing that they cannot deal with the families who are facing foreclosure today. They cannot deal with them in the same manner that they've dealt with them in the past. And this is something that we've been saying from the counseling part of it, that it has to change. These options are available to the consumer, and we need to look at a different way and a more creative way of being able to extend these options to the families.
And it also helps them keep business on the books.
Absolutely.
Right. So we talk about these shifts, and I think we can both agree, or all of us agree, that these are positive for the short term, but we expect this to continue for the long term. These benefits are going to be long stretching. So that brings to a close the first section of this podcast. Stay tuned for part 2.